My name is Anya. I am Communications Director at Sumsub, and I'm honored to moderate the session on financial inclusion and how to drive it through innovation and regulation. So I am joined today by these marvelous superheroes of financial inclusion, the people who are already implementing strategies on financial inclusion and driving the change on the ground. So please welcome again Ely, Kelvin, George, and Robin. Some applauses. So, financial exclusion is a big issue in Southeast Asia. We know that as of 2024, 70% of the population is estimated to be underbanked or unbanked. So the inclusion here is not optional, it is urgent. At Sumsub, we did research called Green Flag, and we know that more than 627 people are not having access to digital services due to reasons like non-standard identity documents or country of origin. So it's very, very crucial for us to find ways how we can drive inclusion. So today we are having perspectives from entrepreneurial, corporate, and regulatory perspectives, and I'm super sure we're going to find best practices that you can later on implement. So I would, without further ado, move into the landscape of financial exclusion, who is left out and why. And my first question would be to Ely. So Ely, you've written about circular financial identity as a missing piece for financial inclusion. Can you please explain what does it mean and how it can change access for underserved groups like women or refugees?
Thank you, Anna. First of all, I want to start this conversation by saying financial inclusion is not charity. It is not just compliance. It is important to all of us because it makes a difference in equality and economic development for every country. So thanks, Anna, by starting the conversation by mentioning circular financial identity. So Anna picked up this because I wrote an article about the concept of circular financial identity, and it was being featured by the ASEAN Economic Forum. The concept of circular financial identity is, it goes beyond just digital identity and also unified identity or reusable identity. It goes beyond that with further steps. It's a concept that applies a dynamic and decentralized and interoperable system. And what I mean by that is just imagine circular financial identity concepts allows the underdocumented population that is currently either unbanked or they have a bank account but they do not have access or have very limited access to any other financial services. With this, on the basis of the circularity of the data, the concept is to first build a profile, identity profile of a person, and start to accumulate the data points by tracking the financial digital footprint of a person or of a business. And from there, we build up the whole financial identity profile to enable these individuals and businesses to further access financial services. Yeah, so in a nutshell, I would say this is a concept to encourage everybody to use the circularity of identity data plus financial data to enable access to a broader range of financial services, but at a risk-based approach.
Thank you, Ely. I think, you just showed why access isn't equal to inclusion. And I would love to add some policy lens. So my question will be to Robin. Robin, tell me, what makes a good national financial inclusion strategy and how can government ensure it leads to real measurable impact?
Thank you very much, Anna. Pleasure to be here at this fantastic event today. So you're absolutely right that financial inclusion has started to be taken very, very seriously as a public policy priority around the world, probably over the last 10 years or so. we've got more than 60 countries that have adopted national financial inclusion strategies. And by the way, that's not only emerging markets. Countries like the US, the UK, they've also adopted strategies in this area. And the evidence is very clear that those countries that do have such a clear framework, especially where it's backed up with quantifiable targets, with detailed action plans, they're making faster progress. We've got good examples in this region as well. The Philippines, for example, before the national strategy was adopted, less than a quarter of the population had access to a bank account or even a mobile money account. That number is now well over 50%. And it's been driven both by digital innovation, but also enabling policies from the regulators as well, all under this synchronized framework that is the National Financial Inclusion Strategy. But of course, the impact is only going to be as good as the implementation. So you need to have certain core prerequisites in place. You need political will to be there. You need clear leadership to be there, whether that's coming from the central bank or from one of the government ministries, perhaps. And you need a shared vision for both the public and the private sector to buy into a sort of clear vision of what success looks like for financial inclusion in the country. But I think something that is really fundamental as well is data. It's very difficult to devise an effective strategy without having quality data. And traditionally, that's been a problem because policymakers have had to rely on demand-side surveys of households conducted every couple of years to really know if their policies are working. But we're seeing a lot of innovation with supply-side data, with subtech innovation, allowing that to be pulled from financial institutions, from fintechs in real time, and actually use AI as well to formulate that into dashboards that can connect to the policy making. So this element of having very adaptable strategies that can be tailored in real time is very, very key as well.
Oh, I see. I really like the point about the quality of implementation. And talking about the implementation of platforms, I would like to now address to George, because Grab has millions of individual business partners, and many of them have limited or even no credit histories. So how do you use data and partnerships to close this gap and make financial service available?
I think, thanks, Anna, for the question and for having me on this panel, right? I think many of you, given that you're in Singapore now, would have experienced Grab. You have used Grab. You probably took a Grab ride today even. So in many of our markets, the people that choose to deliver food on our platform, the people that choose to drive for our transport business, fall into the underserved segment. When we started in the earlier years, something as simple as having a bank account so that we can pay out after you complete a job on the platform wasn't even there, right? In some markets, we had to start, first of all, by helping the driver open a bank account. Today, I think we've advanced a little bit beyond that. And we start to do things like lending, right, to our drivers and our merchants. Now, how and why do we lend to our merchants and our drivers? We are able to lend to our drivers and merchants because they do jobs on a platform, so therefore we can see their earnings. We are able to reduce our risks by ensuring that if they have to make a repayment to us, we deduct from their earnings first before we pay out to them. And by lowering the risk to ourselves, we are able to also charge them less than what they would otherwise be charged if they went out to other lenders in the market. There is a point on education to the wider audience on beyond this room, right? Like what financial inclusion looks like. We have been attacked in the press before, to be very blunt about it, to say, hey, the bank is charging whatever single-digit percentage. Why is Grab charging X% to the drivers? To which usually the very difficult message to put out there is always to say, look, if the driver walked into a bank and the bank were willing to lend to our drivers at, call it 8% for personal loan, we are very happy for the driver to go ahead and take that product, right? Drivers come to us not because they are able to get a loan from the bank and they are able to get a loan from us and decide to pay more because our money smells better, right? They are coming to us because they walk into the bank branch and they cannot get what they would want. as the company grows, I think we are also taking a broader view of what it means to be financially inclusive. So Anna asked about our drivers and merchants. I was stretched into our consumer segment. So what we are realizing as a company with millions of consumers across the region is that the ones that are also left out of digital, as the whole financial services industry goes digital, are also the people that you don't expect and you forget every time people discuss financial inclusion. That's the elderly who are probably not poor by any means, but look at an app. The branches now have very long queues. The elderly look at the app, they go to the hawker center. Some hawkers now say, hey, digital payments only. The guy might have $1 million in his bank, but if he's 60 years old and he has no idea how to make a payment digitally, he is still financially excluded, even with $1 million in the bank. And so we are also increasingly trying to figure out how to bring all those on board when we talk about financial inclusion. We are launching a scam protection product so that when those people come on board and if they get scammed, they are protected to some degree from the mistakes that are made, right, that lead to them being scammed. So it's a bit of a long answer, sorry, but that's our journey and how we're taking a much broader view of financial inclusion than typically discussed.
Thank you so much, and I think it's so important. Kudos for launching the anti-scam protection, because I think the people who are maybe not that digital literate, they are the most vulnerable, and it's very important to support them. So from individuals, I would like to zoom out to small businesses. So Kelvin, question to you: small businesses are the backbone of Southeast Asia, and what keeps these small businesses excluded, and how can fintech change that?
I think maybe a quick introduction. I'm Kelvin, a co-founder of Funding Societies. We're the largest SME fintech lender in Southeast Asia. We operate across 5 countries in Southeast Asia, so Singapore, Indonesia, Malaysia, Thailand, and Vietnam. And we give out about slightly short of $1 billion in SME loans every single year. Been around for 10 years, holding around 11 licenses and whatnot. I think when it comes to SME financial inclusion, I think really breaking down into 2 parts, right? I think ability to manage your credit risk as well as willingness to manage your credit risk, right? From an ability perspective, the reality is that SME credit risk management is meaningfully harder compared to consumers. The primary reason is because there's more heterogeneous factors that could cause SME to not repay you. So a lot of factors that could actually make SMEs to not repay you. Be it it's not just like in consumer, whereby, hey, to an extent, social media, digital profile can give me some level of indication about the consumer's credit risk, or even to an extent, hey, if I control their salary of a consumer or individuals, I can manage the credit risk. The reality is that when it comes to SMEs, revenue sources can come from very wide range. A trade war can impact them, which is something that they can't control. The cost, the team members or staff can commit fraud and run away with money and end up they can't repay you. The customers may do a good job, the customers being late in terms of paying the SMEs, and the SMEs can't repay you. So the factors are a lot more varied. So the reality is that it is meaningfully harder to manage credit risk for SMEs. And when it comes to the infrastructure of Southeast Asia, the reality is that it's also a lot more nascent. Example, we operate across 5 countries, but in Singapore, 70% of our SME borrowers do not have a business credit rating. The most developed economy in Southeast Asia, 70% of borrowers do not have a business credit rating. And 50% of borrowers already have a bank term loan and still decide to come to us because of our speed and flexibility. And the reality is that if you want to manage this credit risk, it's possible, but the data and information is so fragmented such that, hey, how many Grabs are there in the world? It takes billions of dollars to actually build that access to even serve that number of merchants. And so overall, the nascency of infrastructure makes it actually very hard, be it in terms of credit bureau, in terms of data sources, data profiles, make it very hard to manage a credit risk. But if flip on the other side, in terms of willingness, banks have billions of dollars of profits. If they really want to solve this problem, they can solve this problem to get there, right? But the reality is that the ROE for SME lending tends to be lower compared to consumer and corporate space, right? The risk-weighted the RWA, risk-weighted asset, tends to be lower, and that a lot of information are actually fragmented across different parties. So, for example, recently, even as a fintech lender, we still can't access the Consumer Credit Bureau of Singapore because it's owned by the Association of Banks, and hence that information is kind of fragmented from us. And then you have a telco company starting up with a Singapore Commercial Credit Bureau because they want to protect their data, right? So the reality is that from a self-interest perspective, it is understandable that everyone wants to keep their portion of data, such that it's actually very hard for you to have a full view of the whole SMEs and hence manage the heterogeneous factors that could cause the SMEs to default. So it's really a combination of both ability as well as willingness, such that you see SME financial inclusion tends to be still lagging behind. And I think where we come from is really by taking a long journey approach, we start accumulating our own set of data and information, as well as credit risk management experience, and be resolutely focused in terms of solving the SME problem, such that we have actually built our business in the last 10 years.
Thank you very much, Kelvin. So now that we've mapped out, let's say, the landscape of exclusion, let's move to the regulation. And I have another set of questions for you. So we will start with Robin. So across APAC, what regulatory obstacles show up most often?
Thank you. I think one of the obstacles is simply the challenge that regulators have keeping pace with technology. Singapore might be a little bit of an exception here, but most regulatory institutions will have limited technological expertise, they'll have many resource constraints. So just keeping up with fast-paced developments in areas like Gen AI, in DeFi, and actually understanding and assessing the risks in a deep way is very, very challenging. Beyond that, I think we have to recognize APEC, even ASEAN, are extremely diverse regions with countries at very different stages of economic development, very different histories, even legal systems. So regulatory fragmentation becomes quite a big challenge. It's not a simple matter to develop a product in one market and then passport it to other markets. So these are some of the friction points. Some of the things that policymakers can be looking at to overcome that. One is, I think, just to meet the technological innovation with policy innovation. So we can't just practice regulation as it always has been done in the past. I think we've heard a bit today already about things like regulatory sandboxes that you have here in Singapore, popping up around the region and the world as well. And they can be very, very useful to allow for live testing of fintech products and to make adjustments before full deployment. Malaysia, I think, has been an excellent example here. They've now tested more than 125 products across payments, insurtech, other areas. And many of those have gone on to reach full scale or to lead to more detailed regulations later. So that is one. The other is the need for really proportionate regulations. So you can't try to apply Basel III to every entity in your jurisdiction, for example, or you have very limited inclusion, very limited innovation. That's an area I think we're seeing interesting developments, like the digital bank licensing from many countries in ASEAN. So really, regulators need to make sure that the regulations are tailored to the activities, tailored to the actual level of risk, and then not sort of just gold plating or going in a too heavy-handed way there. And the final one, I think, is the need for regional collaboration. So areas like fraud and scams that we've been talking about today, can we have more effective information sharing between different jurisdictions, maybe looking at the kind of APIs and supervisory technology deployments that can allow that to happen, just to really be on the front foot in areas like cybersecurity, rather than just reacting once we start to see the consumer harms manifesting.
Oh, I see. So, Kelvin, you are operating in 5 markets, and as Robin said, they're very different, fragmented regulations. So, in short, in which markets you would see, more beneficial regulations, and where maybe you're holding back?
I think first and foremost, I've been really grateful for the regulators in Southeast Asia to really even enable fintech to start and to an extent flourish in Southeast Asia, right? And this can't be said for many parts of the world. So, but I think what you'll notice is that among the 5 countries that we're in, Malaysia interestingly seems to have the most progressive. Let me rephrase. Singapore started the regulations probably the earliest. In terms of enabling fintech companies to start doing SME, initially peer-to-business lending and eventually government risk-sharing program as well. So Singapore started the earliest, but you'll notice that actually Malaysia, while it seems to be a very fast follower and have pushed quite a few progressive policies. Example, we talk about one of the biggest problems when it comes to SME lending is data access, being fragmented, being the need to manage heterogeneous set of risks also. BNM have just come up with a whole strategic initiative towards driving open banking, which is something that I think Singapore has tried and explored, but has been taken a more, voluntary basis for the last 5-10 years, and as a result of that, very limited open banking actually has happened in Singapore. Whereas in the case of Malaysia, because they see that as a public good to actually push for this initiative, therefore they're actually driving it. So really taking steps towards addressing data access for fintech companies to serve SMEs. But also on top of that, you'll notice about funding. So when it comes to our crowdfunding business for SMEs, for every $2 that we crowdfund, the government's co-lends $1 with us. And that way, it really crowds in the private sector money to actually start supporting financial inclusion. And in fact, people may say that, hey, SMEs are such high risk, the government is really doing charity for it. But even to look at the Securities Commission's report, this program has been pretty profitable for the last few years or so. So I think to that extent, not just in terms of setting the basic stage for companies to even start operating legitimately, but also solving a big problem with data access, and finally crowding in private capital towards alternative financing has really enabled the whole SME fintech sector in Malaysia to grow quite significantly as compared to probably the peers in the market in Southeast Asia.
Oh, thank you so much. Ili, a question to you. What role should regulators play to support ideas like circular financial identity, in your opinion?
Thanks for the question. There's no straightforward answer, and I think by now, most regulators all over the world, they are very clear that public-private partnerships are very, very important. But it's easier said than done, right? So they have the intention to do it. In private sector, of course, as businesses, we want to collaborate with regulators. We want to co-create the pathway, the future of our industry together. But I don't have a perfect answer for this, but I think all these conversations and actions should be led in a more highly coordinated manner, like what Mr. Raja Kumar said this morning at the opening speech. So when we want to do it in a highly coordinated manner, it has to be intentional. So someone has to orchestrate these conversations. So like AFI, they've been doing a great job. You know, they have all the members as central banks, and all central banks comes together and do brainstorming, do several workshops and different form of discussion to foster this. In the private sector, I have not seen any industry-led or private sector-led initiative or association that is focused on financial inclusion only. Mm-hmm. Yeah. So with this at XCube, so a little bit of context, XCube is an ecosystem builder. So we have recently established a consortium that is industry-led, private sector-led, to only focus on one thing, to drive financial inclusion and advanced financial inclusion. So we don't know everything, and we want to collaborate with our peers in the private sector to advance this movement and cooperate with the regulators, policymakers, or even legislators. So we are just at the beginning, I think, and we welcome interested partners to approach us, come and work with us, and embed financial inclusion in your business strategy that generates commercial outcome.
Thank you. And the last question in this section for George. I know that Grab works closely with regulators, for instance, with MAS in Singapore. So what's one regulatory innovation that made a real difference, in your opinion?
I think domestic interoperable payments. Governments across Southeast Asia have been remarkably similar and progressive in making advancements in the area, right? So if you look at, actually even on this, going back to Kelvin's point, I think Singapore started first, but somehow even in domestic interoperable payments, Malaysia seems to be sort of, a little bit more advanced in the thinking currently. But all countries, and I mean all, including even say Cambodia, that one would think of as amongst the least developed countries, have all made progress in bringing about domestic interoperable payments, right? So you go to anywhere, almost anywhere in Southeast Asia today, the local bank apps, the local wallet apps, the local fintech apps can scan a common set of QRs that are provided by some other sort of acquirer, and payments can happen digitally. Contrast with maybe the worst case scenario would be, say, like the US, right? US, this is like, I don't know, maybe 30 years from now, this will happen, right? It's still very much a card-heavy market. ACH or account-to-account payments don't really exist, or are very fragmented, right? So I think that's Kelvin talked about how in credit things are a bit slower, regulatory environment is a bit tougher in Southeast Asia, but I would say in payments, it's really driven real growth for everyone, like the entire economy.
Yeah, I agree. I mean, I'm astonished. I'm first time in Singapore, but the payments here, you can do it with QRs, with everything. It's amazing. Okay, I think we've covered the regulation block, and now I know we're a bit, longer in time, but I think we have a great discussion here. So I would love us to cover the final section on innovation. And George, I want to stay with you because, GrabFin is not only about payments, it's also loans and, it's about literacy programs like anti-scam protection programs. So if we're talking about product innovations, what was the one that has driven the biggest change again?
Yeah, so actually the ability, and I'm saying this not just because Sumsub organized this conference, but honestly speaking, digital identity, KYC, I think has been the biggest unlock, not just in Southeast Asia but across the world, right? I mean, pick any service, from our point of view as Grab, whether it's ride-hailing or food delivery, payments, lending that Kelvin does. If you can't verify and confirm with any degree of reliability somebody's identity digitally, you can't sell anything. You can't offer any service, right? So I think being able to identify somebody's identity with very high degree of accuracy online is the first step to doing anything at all. So that's, I think, is innovation at scale that has really taken off in this region. Yeah.
Well, as a representative of Sumsub, this makes me very, very happy. But yeah, I do agree. Like a smooth verification and secure one is actually the entry to digital services. Kelvin, I want to follow up with you. And I know that Funding Societies has disbursed like a huge amount of money, $4 billion. Amazing. But how do you see AI, new tech, digitalization helping you to manage risk? While serving, these SMEs that traditional banks are not serving?
I think this has been quite a common question, right? Maybe a few areas. I think, candidly, when we first started off, AI, everyone talks about it, but it was quite useless for us because AI is driven by data. We don't have data. So what AI are we really talking about? But I find that Gen AI has actually been very powerful in a few ways, right? One is that it allows us to actually structure or ingest unstructured data and use it meaningfully, right? So previously, for example, bank statements, I can digitalize it or parse it quite straightforward, in a straightforward manner. But financial statements vary from company to company, right? And that, unless you put in a lot of human resources, it's actually not very easy to ingest that data in a very structured way. But Gen AI allows us to do that. Text to voice. So previously, when it comes to be in terms of customer surveys, it takes a lot of resources because in what Peter Thiel said, right, serving SMEs is really a zone of death when it comes to distribution. It's extremely costly, right? But with text to voice, I can do AI telecalling, be in terms of sales or be in terms of collections. I can be very sure that for collections, I can call you 4 times a day based on regulations at the time that I said it would be, and in a very professional way without emotions, right? That has been very efficient for us, right? Or even in terms of compliance or credit scoring, so on and so forth. So actually, AI wasn't as useful, but Gen AI has been quite powerful for us. But in other areas of new technology, be in terms of blockchain, can really not as helpful because at the end of the day, yes, we talk about identity verification when it comes to supply chain, but unless the big boys start adopting it, candidly, for a small company like us, we're not going to drive industry change. We can catalyze it, but we're not going to lead it also, right? And when it comes to Southeast Asia, fortunately, it actually does require either government-linked companies or big tech firms to do it and be willing to open access to the rest of the ecosystem for us to adopt it in a meaningful way, right? Finally, probably stable coins, right? That is something that we look at it quite closely. It probably helps in our overall payments business, but we don't see a very meaningful way as to how it will help us to serve our SMEs in a faster, cheaper, better way for now, based on our business model also. So I think overall, the technologies has been very helpful, but really it's how we apply it in our context, especially in the case of Gen AI, that has been a very meaningful impact for us.
Thank you so much. Robin, you already touched it, but we know that regulators often fall behind, unfortunately, on the tech. So, in your opinion, what can regulators do to keep up with all the, the explosive, innovative tech?
Yeah, I think one is just to have a very open mindset, a continuous learning mindset, and to engage regularly and actively with the entities that they're regulating. So we see quite good examples of regulators running tech sprints or hackathons, really inviting the fintechs in and learning about their business models from an early stage. So that's certainly one. But I think more than that, regulators and the public sector generally also needs to innovate within its own domain if we're to get to scale. So that means in areas like digital public goods, inclusive digital infrastructure as well. So things like the digital identity that was mentioned is very critical. Fast and interoperable payment systems, so that once you get into the financial system, you actually have access not just to a product, but to the whole ecosystem. And also we're starting to see innovation in areas like open banking, open finance that was mentioned as well. And that's going to be key to enabling, lowering barriers to entry, first of all, and also enabling much more collaboration between banks and fintechs. So there's a lot going on, but we need to make sure that we're learning the lessons from each jurisdiction so that we can move a bit faster in this area.
Thank you so much. I hope they will do it faster. And Ili, I have a last question, but I think it's like, the most practical maybe, about scaling. So in your opinion, what does it take to move from just pioneering projects to scalable solutions for financial inclusion?
Yep. So as a venture builder and ecosystem builder, we work with many businesses, from large-scale corporation to very early-stage startups. So one of the common challenges we see where projects stuck at pilot or POC stage is where the public sector or the regulators, they don't see the impact comes after that. Yeah. So on the private sector side, I think we need to do better in articulating the impact for the government, for the regulators, and for the society and the nation as a whole. Because financial, as I mentioned in the beginning, financial inclusion is not just charity. It has tangible economy and social impact to the country. So instead of just selling the technology and the innovation itself, which I don't think technology can solve all problems, we should be focusing on the impact that comes after that. And as business, we need to think from our perspective, how do we make this sustainable in commercial sense, so that we can continue to do this and we can continue to use technology for good.
Do you want to mention about the white paper?
Yes, thank you. So with this, we at XQ, we have actually recently just published a white paper on this inclusive finance topic. So if this is of interest, you want to learn more about it, how do we, move from just talking about financial inclusion to tangible action? How do we move from access to real impact, societal impact, and economic impact? This is where you can scan the QR code and download the white paper. Thank you so much, Anna. And before I forget, thank you so much to Sumsub for supporting us in this white paper as well.
You're more than welcome. We're very happy. And we are encouraging everyone to download the white paper, because you already had a lot of actionable insights from our dear speakers today, but also I believe you might find something helpful here as well. So just to wrap up, I think that what we've heard today is, first of all, that exclusion is not just lack of access. It's about fragile identities, no or little credit histories, and fear of scams. And inclusion means usable, safe services for real people and for real SMBs, not some theoretical. Regulation can enable, but only if they keep up with the technology and if they think about real users and real businesses. And of course, innovation must scale responsibly. So only smooth KYC financial services can widen the door if they are paired with fraud defenses, with anti-scam protection programs, with stronger user defenses. So thank you very much, Eli, Calvin, George, and Robin. It was amazing to have you here. Thank you for your insights. And yeah, let's give a warm round of applause, guys. Thank you so much. Thank you, the audience.